All right, I think we're up and running now. It's 7 o'clock, and again, we want to thank everybody for being on this morning. It's always a pleasure to have everybody early on a Wednesday, third Wednesday of the month, and look forward to it. And there's a lot of good information transpires within this next hour. So I just saw that we have Kara Matheny. She's one of the co-hosts of this program, and grateful she's on this morning. She's the Ag Natural Resource Agent in Victoria County, and again, we're grateful everyone that is listening or going to see this presentation in the next few days and right now. So we're going to turn it over to Dr. Anderson. He's our livestock economist, state livestock economist, and I'll turn it over to him and see what's going on in the livestock industry.
Well, Bobby, let me ask all of our usual questions. Can you see my slides?
Yes, sir.
No kidding. Well,
Prices define seasonality.
Gave me a different signal, so I was not sure. But anyway, hey, it's great to be with you this morning. We're going to talk cattle market a little bit. I kind of called this prices defying seasonality because, typically in the fall, our calf market begins to decline a little bit seasonally. Cull cow market begins to decline seasonally a little bit as more animals come to market. But so far, so good. We don't have much of that going on, and it's really due to just plain fewer and fewer animals for sale, I think. But with that as a backdrop, let's jump in. I think there's a lot of questions or comments or things. I think the one thing is, as we look at sort of as a livestock economist, we're 2 weeks or so into this shutdown. We're starting to lose a little bit of data, particularly on the production side, slaughter and cattle slaughter, beef production. We're losing that data. We're still getting price data. And in some ways, I think that's certainly pretty good because it's the AMS USDA price data that lets us settle the CME feeder cattle and fed cattle, live cattle contracts. And so you need that price data for the futures market to work. We're supposed to have a cattle on feed report, I think, next Friday, but unless something changes pretty fast, we're not going to get that. The unfortunate thing there is it's October, and that brings us the quarterly cattle on feed report that has the breakout of steers and heifers on feed. And I think this one was going to be one that was going to be the most interesting number because we're really looking for a decline in the number of heifers on feed, implying a lot fewer heifer placements, meaning that we're holding them on the ranch instead of sending them to feedlots. And so that's a little piece of data I think we're going to miss that was actually pretty important right now in terms of understanding, are we starting to turn the ship a little bit? So I'll touch on some seasonal cow prices. I think we've got some interesting stuff happening there. A little bit on tariffs and other stuff based on questions I've been getting really since we visited over the last month, a month ago. Questions about things like that are going on and what do we see from tariffs. So I'll kind of hit that too. I want to start with cull cow prices. I said defying the odds a little bit. Cull cow prices typically peak seasonally in about May, June, roughly. We did that as well this year, getting into July, but we've been about 165 for several months. We had a little decline about a month ago, and I thought, well, maybe we will see some seasonal, a little bit of seasonal weakness, but we have ramped back up pretty close to our high for the year, really counter seasonally. But I think that really relates to very high prices for lean beef coming from old cows, really driven by the hamburger market. Driven by a little dab of some tariff pressure on imports, and most of our imports are lean beef trimmings that go into ground beef. And so, that's working together, I think, to keep these cull cow prices high. One reason prices decline in the in the fall is because that's when most cows are culled. So my red line here is a 5-year average of beef cow slaughter. So those are cows that are culled from ranches when they're past their productive life. Pretty easy to pick out the high point for the year in this October, November time frame when culling picks up. And that's, it's driven by kind of production patterns, production seasonality. So we get more culling. Even last year with the sharp decline in the number of cows being shipped from ranches around the country, we still saw an uptick in culling. Now our data cut off about a couple of weeks ago here with the shutdown. But what I would point out is beef cow slaughter has certainly been well below a year ago. And we expect that to continue. And one of the things it might suggest is I'm not sure how much room we really have for an increase in culling. So that's going to keep those supplies tighter and prices higher. Just simply there's fewer beef cows. Now, beef cow is only part of the story on cow slaughter because the dairy cow complex is the other part of it. And what it turns out is in our last monthly milk production report, we had just over 9.5 million beef dairy cows in the U.S. That is the most since 1993. In the January inventory report, that's a lot of dairy cows. We've actually been moving between 9.2 and 9.4 million dairy cows really since 93. So we've seen a pretty sharp increase driven by some profits, low feed costs, good milk prices have driven us to expand. That expansion has happened, and what you see really is an uptick in cow slaughter because we have a bigger herd. So as we've grown and have a bigger herd, we've got more that are reaching the end of their milk producing life, and they're going to market. And that's helped along by these high cull cow prices too. So you look since mid-year, really our dairy cow slaughter is picking up. You'll notice on that 5-year average that they hit their highs early in the year, but then we build some into the fall with some additional culling. So we've got really what normally coincides with large beef cow slaughter, little bit of seasonal increase in dairy cows. Now I think we've got some pretty low beef cow slaughter continuing, and some pickup on the dairy side. So those supplies our supplies of that beef really move from both the dairy industry and the beef industry. And I think that seasonality is pretty important. But regardless, a lot fewer animals going to market. The demand for ground beef is still there, and we got some pretty high cull cow prices continuing. Look at the calf market. When I said defying seasonality, we've built prices all year long from our lows, really the first of the year, hitting in these auction markets, touching 450 per hundredweight. Little bit of decline, but really not much to speak of, quite honestly. Fewer, a lot few calves, fewer on the market, fewer for sale, and some good demand from feedlots. I'll let Mark Welch talk about maybe if we got any wheat for him to eat anyway, if there were any around to buy to put out on wheat pasture. But we continue to have high prices and in the calf market, and there's really not much reason for those to go down, at least near term.
Hey Doc, I don't know if your slide. I don't know whether your slide's advancing.
Not at all.
We're still on dairy cow slaughter.
Okay. We just sort of locked up a little bit, I guess. Let's see here. Did we move ahead there?
No, still frozen, David.
Let's see here. We'll jump out and try something different. Did that move us ahead?
Yes, sir.
There you go.
Yes.
All right. Maybe we've restarted here. I was talking about the calf market, 500 to 600 pound steers, and not much, maybe a little touch of seasonal decline, but boy, that's not much to speak of, quite honestly. Did I advance this slide to sorghum prices?
Yes. Yeah. Doesn't look good, but yes, we see the slide. Yeah.
So, lower feed costs are certainly part of it. Normally I would use corn prices. I just thought I would use a sorghum price kind of slide today. But they both, and if I'd have used soybean meal, distillers, all of these basic feedstuffs of our feed rations in feedlots, we've got prices falling at some very low prices. I thought I would just use this as sort of an example. You can certainly see the slide this year in prices, and particularly in this market from above a year ago to below a year ago. But part of that support for calf prices is coming from the feed side. With lower feed prices, that's driving calf prices higher. And so, I think we got to remember, and it's not just few calves that are for sale that are the issue, but it's lower feed costs boosting that feedlot demand for calves. And so I think this just sort of again reinforces and highlights that notion that this wreck we have on the crop side is feeding into higher calf prices. The other thing feeding in, we continue to have the border closed to feeder cattle imports from Mexico. It's pretty easy to see that zero for weeks and weeks now. I think the thing worth pointing out is you'll notice on my red line, which is a 5-year average of imports, we really have this seasonality to imports where they peak in the spring and they peak in the fall. And so now what we have is we're getting into the time of the year that we hit our biggest numbers of imports. It means that difference to a year ago compared to a year ago is bigger, and it's going to further cut into our supplies of feeder cattle coming into the market. So I include this. We all know the border's closed. We all know that's going on. But again, this notion of what we're comparing against and really cutting supplies of feeder cattle. Fed cattle prices continue to hover in the mid 130s, 230s. It was a 5-year average was the 130s. We're in the 230s now. Again, a touchdown from that peak, but again, certainly very high prices for fed cattle. I think the cutout is pretty interesting as we think about the wholesale market. You see a roller coaster going on, and that's really not unusual in these markets, in the wholesale beef market, reflecting those 7 primal cuts. We advanced over 410. We're down to about 365 now in the wholesale market. Seasonally, we do tend to see a little bit lower price in terms of the cutout in the fall, driven by some production seasonality with a little more production. But again, we're shifting over kind of from grilling season demand to fall and more winter beef demand, and that reinforces some other cuts that advance in value compared to what peaks in the summertime. So again, some ups and downs in the cutout market, but still record high for this time of the year. Couple things on tariffs. I've been asked this question a lot. Who pays the tariff? And as an economist, we'll talk about, the importing country's consumers are going to pay for it there. Producers pay for it in the exporting country. But, the question I've been getting is who writes the check? And it's the importer that pays. So that company that imports pays the tariff. I think another thing that's lost in this, just in how we tend to talk about tariffs, and I would highlight that it's companies that are importing stuff, not countries, for the most part. Now, there's some exceptions to that, but as we think about the U.S. importing, it's companies, not countries. And I think that makes a difference, because what it adds to then is how are costs passed to the consumer, and if they are. What do we see in terms of rising prices as those tariffs are passed on? Yet we may have negotiation between companies where the exporter may really need the business, and they may pay, in essence, pay some of that tariff or cut the price to allow that importer to pay the tariff and still bring it in. So we've got this. There's just a lot of moving parts on the tariffs, and it's not just we know that consumers sooner or later will pay the tariff. But in that time period, who writes the check? How does this negotiation work? How do these go through? Is I think some important nuances about how tariffs really, when the rubber hits the road, how do they work? And in livestock markets, I think there's a couple of other things that we ought to think about, is that there's other stuff besides the tariff. In fact, the tariff in some of our livestock markets is actually pretty small. and relative prices matter a lot. And I say that on the beef side is because we have record high beef prices in the U.S., but our prices have become much higher than other countries that we might import from, and that relates to the situation in each country, production, supply and demand in each of those countries. We just have very high prices, which means we're importing a lot more beef. And so even though a tariff has shown up, the tariff may not mean a whole lot considering relative prices. Now, one of the things going on in just the last few couple of weeks and months, we've got some rising prices in countries like Uruguay, Argentina, places like that, where beef prices are rising and narrowing that spread between the U.S. and those countries, which is going to have an effect on imports. Exchange rates matters in this. In fact, a lot of times in exchange rates, which are going to be related to a bunch of other internal things in the country, including inflation, kind of economic strength, stuff like that. Sometimes these moving parts move in opposite directions and opposite effects. And so it becomes harder and harder to tease out the effect of tariffs. But I'll close with this one last slide real fast. This is the U.S. exchange rate versus two countries, Australia and South Korea. And, in terms of beef, we import from Australia, we export to South Korea. And I would highlight the part on the right-hand side of this slide, really 2025. And we've had a declining value of the dollar versus both of these currencies over the last few months. So as an importer, when we're buying beef, that our weaker dollar doesn't go as far. I think that will continue to sort of have an effect on, in this case, Australia, making that Australian beef a little more expensive, working in tandem with the tariff, you might think. The dotted line is South Korea. You see a weakening of exchange of the U.S. dollar versus the South Korean currency. We export to South Korea. That makes our beef a little more expensive for South Koreans. And so that may work against, that weakening of the dollar may actually help some exports a little bit, just because it makes our stuff maybe a little bit cheaper for them. So I think that highlights two markets that are going on, and both export and import, where a weaker dollar versus those currencies plays a role in what's going on with tariffs, particularly on Australia, because we're talking about our own import tariffs. So there's a lot of interesting stuff, a lot of moving parts on trade, but I just figured I'd highlight those just real quickly. And essentially, that's my last slide. Thanks for bearing with me as I talk fast here. I think I've stopped sharing, and I'll leave it at that. Thanks.
Great information. Again, the livestock industry is in pretty good shape at the moment, so it's always good to hear. I do have maybe something for, excuse me, another day, but to put it to you, has any of the economists looking at the correlation of number of cattle in relation to amount of land that we're supposedly losing a year to urban sprawl and all the other stuff? Roughly 1 million, that's what I've been hearing, 1 million acres a year. Is anybody looking at how, I know we're good at producing on limited resources, but how the cow market or the cattle numbers correlate to the amount of land that we're losing?
Yeah, in fact, I've got a grad student who's been working on that. We had a little paper at our Southern Agricultural Economics Association meetings on that very topic back in February. I'll tell you what, next month I'll include that in this, and we'll talk about that paper a little bit, what we found and what we didn't find, and some directions we're working on now on that very question. So that's a great question.
Well, again, thanks for being on with us this morning, and always appreciative of the information you bring. So up next, we've got Dr. John Robinson. He's going to talk to us a little bit about the cotton market. So Dr. Robinson, take it away.
Thank you. Does the slide look okay to you?
Yes, sir.
All right. Excellent. Well, I'm also like David, gonna highlight a few things that we don't know because of lack of information flow from the shutdown. We get a lot of different sources of information from USDA and other federal agencies, and so most of those has stopped, with the one exception, at least the one that I found, the Agricultural Marketing Service, AMS, are the people that publish daily cotton spot quotes, and they quote grain prices on the radio, and they publish cotton quality stuff. They're still putting stuff out. So I guess that means they're essential. But anyway, AMS is still doing their thing. Of course, the futures exchange is not a government entity. It's a private thing. So ICE futures have continued to be published, and I'm assuming Chicago Board of Trade has too. So we've still got futures prices and cash prices as a flow of information, but that's pretty much it. Other USDA agencies that we frankly depend on have been shut down now for 3 weeks plus. So that includes the National Ag Statistics Service, or NASS. They put out weekly crop progress and crop condition ratings. Okay, none of that's been happening. They do monthly production that goes into the WASDE report. That hadn't been happening. And NASS on the cotton side publishes cotton ginning reports. So none of those information flows have been happening. Um, there's an entity of USDA called the Foreign Ag Service, FAS. They publish weekly export sales of major crops, including cotton. We look at them to kind of judge the pace of weekly demand. That hadn't been happening. And lastly, all that weekly stuff feeds into the monthly stuff. The WAOB is the World Agricultural Outlook Board. They're the ones that publish the World Agricultural Supply and Demand Estimates, or the WASDE. We missed the October WASDE because it just didn't happen. So that's USDA. There's other federal agencies that publish information that's also helps us interpret where major crop markets are, how they're trading, and particularly um, how they're being settled on the futures market side, and in particular how they're being influenced by speculators. And so the agency I'm talking about is the Commodity Futures Trading Commission, the CFTC, who they're the ones that regulate the futures markets. Anyway, the CFTC publishes two weekly reports, which have neither one of them has happened. One's called Commitment of Traders, and the other's called the Cotton on Call. They both shed light on what speculators are doing in the market, and how hedgers are settling their on-call contracts. And so we haven't had that information for 3 weeks. And so I'll just close this long spiel of rambling update here by saying that the lack of public information, who does it hurt the most? I think it hurts the small grower segment the most, because they're the people that don't have alternative sources of information. If you're a big multinational cotton merchant, you've got people down the hall that are doing exports. You've got a good sense of what the export situation is. You've got people you talk to in China every morning. You got a pretty good sense of what's going on internationally. You got a pretty good sense, as good as anybody, of what's going on with production. They've got more resources than the grower segment. So this lack of information is an advantage to the larger segments, and it's a disadvantage, in my opinion, to the grower segment. So let's just hope it comes to an end. Since futures prices are pretty much all we've got to work with, here's a picture of the last couple of years of the December contract for cotton. You can see we were coming from a slide that started back in late 2023. The Chinese were restocking their government reserve, so they imported 15 million bales. Well, that stopped, and that took away that bullish influence, and we've been on a slide ever since. And the slide lately has gone from the upper mid 60s to the lower 60s. This week we've been in 63 something, so it continues to be bearish. Here's some of the data that hasn't been updated. The far right column are the supply and demand estimates for cotton, for U.S. cotton. They're 4+ weeks old. We're in the harvest time of the year, and so this could be the time of the year when they would come in and make an adjustment. Maybe in real life there has been an adjustment, but we won't know about it. And so it's going to make the markets less efficient because the regular flow of info has been interrupted. But where we are right now, we're in a situation um, where projected ending stocks are a little lower than the previous year. That's 3.6 million bales of ending stocks compared to 4. That's roughly the same level. So you would conclude from this that we would expect prices to be somewhat similar for the 25-26 marketing year as compared to the previous one, because ending stocks are somewhat similar. This is another picture of that needs to be updated, but we haven't had the data for the commitment of traders from CFTC. We haven't had the data in 3 weeks. So who knows whether the speculators have been building their short position or whittling it down. Frankly, we don't know. And obviously, we haven't had an update on the export situation, so we don't have unless you're a big merchant, we don't have a feel for demand. And I'll just kind of close with what I think about is coming next year. Right now, relative prices would suggest that we would probably plant somewhere in the neighborhood of 10 million or less. Now, that's going to be influenced by the weather because we are in a La Nina situation, which generally results in dry winters. If we do have a dry winter and a dry first quarter, that tends to stimulate more planting of cotton than what economics would suggest. This slide is predicting how many acres of cotton will be planted based on economics, but in a La Nina drought situation, it's people tend to insure more and plant more cotton as opposed to swinging over to grain sorghum or corn or something like that, because cotton agronomically, you're better off growing a more drought resistant crop. And even if it's a loss, you're better off penciling in a cotton loss than some of the other crops. And so we tend to see more cotton planted in those kinds of years. So we'll have to see just some milestones of what the acreage will be that we can expect to get information from starting first quarter of next year. And you can see it's already dry. It's okay for the places that are waiting for cotton to mature and bolls to pop open. Sunny, warm weather is all right, but it's coming at the cost of next year's situation. So again, we're kind of beginning to slide into a drought expectation, and that should color our views of what the supply and demand situation will be, which are shown in the right hand side column of this chart here. I've got 10 million planted acres in here. I've got a somewhat above average abandonment that probably needs to be raised, but right now I would project a crop of 13 something million and wound up with ending stocks down at the bottom pretty much the same as what we have now. But this could really change quickly depending on the drought response. So we'll be watching that, and the market will be watching that very, very closely. If there's any chance at all for December 26 futures to have a rally, it's going to be basically in response to expectations of drought. So we'll be watching that. And Bob, that's all I've got, so I will stop sharing.
Well, we again appreciate the information, and it's kind of funny not having those pieces of information coming to you on a regular basis. I know a couple of weeks ago I couldn't figure out why I couldn't do my weekly crop report, and it dawned on me that all of them are shut down. So anyway,
It's like you're flying blind.
yeah, I get you. Yes, but we appreciate you being on this morning as well. So uh, we'll move to our next speaker, Dr. Mark Welch, who's our grains specialist, a marketing specialist, and I'll turn it over to him.
All right, Bobby, always good to be with y'all on these Wednesday mornings, as you mentioned, once a month. Hope you can see the slides and hope the audio was all okay.
Yes, sir.
Really glad to see Angie Martin on the call today. I appreciate so much the perspective and insight that she's going to be able to bring a lot more detail and a lot of aspects of the corn and the grain markets that I don't follow and have access to on a regular and basis like she does. And so I appreciate the expertise that she is going to bring. I'm going to kind of have that 30,000 foot look through the fog as we're all mentioning here what we don't know so much about these markets, but how we'll maybe can navigate. And so there's still some information out there that might provide us some useful marketing information. I start many times with this schematic of the grain market and that all important influence of the ending stock relative to our total use for any grain for price determination. And as already been mentioned, with the government shutdown, one of the primary drivers of price action, I think, in the last several months has been our yield question. We've got a big crop out there, but what's that final yield going to be? Well, we've kind of lost access to those updates with the crop condition report on Monday, and obviously the crop production and WASDE report there for October. On the demand side, exports are absolutely critical to maintain a robust presence in those markets, those international markets, to keep those stock levels from building too high. And so we don't know that. And so we're kind of, as has been mentioned, flying blind in so many cases. And I think Dr. Robinson hit it right on the nail, right on the head. Archer, Daniel, Bungie, Cargill, they have a pretty good handle on all these kinds of things. It's that publicly available, transparent release of information that we're lacking in this particular market. And we'll sort it out over time, but it does really hamstring us in terms of responding to current market conditions as well as planning for how to manage this crop this fall and making plans then for 2026 and all that. Then how do you arrive at a fundamental expectation of what the grain price kind of ought to be, given all these factors when we have these big blank areas? But we're gonna touch on some of that and maybe explain a little of kind of where we are and why we're where we are right now with these grain prices. Where we left off at the end of September, a corn crop that was still rating well above normal crop condition ratings. We've been there pretty well all season long. Most of the year we spent with over 70% of the crop in those green areas in that good and excellent categories. We've had some increase in those fair conditions as we're getting toward harvest, as it's gotten drier across much of the Corn Belt in particular. But still, that condition rating, that black line is still above that blue dotted line, which would be a crop condition index based on those percentages of crop in those various rating categories. Now, to zoom in a little closer on comparing where we are this year compared to average and the last couple of years, to focus on the index itself, again, you can see that red dotted line, a red line with the markers on it. That's this year's crop. That's the 2025 crop. The black dotted line would be an average index. Then you can see the 23 crop in green and the 24 crop in that blue color. And the condition ratings have been better. They were falling off here toward the end of the year. Typically, what we would see to maintain that yield potential into October, November, December is those condition ratings improve just a little bit. The crop's pretty well made And so you wouldn't expect further deterioration in that index. Has that fallen off or not the last couple of weeks? There's been a lot of concern of some disease pressure in many major producing areas of the Corn Belt. Those perhaps areas of the field that should get the combine running. Maybe there's some drowned out areas, those low-lying pieces of a field that didn't produce as well. What do those look like? What component of the crop do those comprise? We just don't know. And so there's a speculation around, will we hold that most recent estimate of the yield at 186.7, which is still an outstanding yield. In August, it was 188. USDA backed it down to 186 in September. We were really looking forward to that October update. Have we slipped a little more? Are we holding up at that 186? Critical market information. That kind of puts that yield in perspective of how yields have grown. That chart goes back to 1980. And on a trend line basis, we increased the corn yield in this country just under 2 bushels per acre per year. A straight trend line estimate would have put this year's crop at 183. Again, in August, it was 188. And the most recent estimate in the September WASDE and crop production reports, again, was 186.7. But still, absolutely an outstanding yield. But the question is, will that hold? One factor that might provide some information to answer that question is, how warm has it been at night? How quickly have we accumulated growing degree days this growing season? Elwyn Taylor, a climatologist and agronomist from Iowa State University, who was a longtime presenter at our Master Marketer program, he would regularly make the point that it's key for crop development that the temperatures, particularly at night in July and August in the Corn Belt, in that if it's warmer than normal at night, we tend to accumulate growing degrees more quickly. And that doesn't give the time for the crop to put on weight that it needs. If it's cooler at night, if we're collecting those growing degree days at a little more slower pace, the crop has time to put on weight. It gives the time to rest in the evenings. That's why we need these cool, clear nights to really enhance the yield possibility and potential of the corn crop. And so if you look at what's happening in 2025, first of all, start in the lower right-hand corner of this slide, these are low temperature departures from average in the Ames area. So we're right in the heart of the Corn Belt, Ames just north of Des Moines, right there in the center of Iowa. The red bars would indicate nights that were above average temperatures. The blue bars is when it was cooler than normal in the month of July and August. There are 44 nights where it was warmer than normal and 19 when it was cooler. And much of that cooler phase came at the latter part of August. So it was a warmer nights in that heart of the Corn Belt as we were getting into July and August. And Elwyn's proposal or hypothesis is, when we have warmer than normal nights, when we have growing degree accumulation faster than normal, USDA's August yield estimate is too high. If it's warmer than normal, they're going to overestimate the yield. If it's cooler than normal, they're going to underestimate the yield. So the adjustments that are going to come in September and October, and then by the time we get to December, that if it's been warmer than normal, we're going to see those yields reduce compared to those early estimates. If it's cooler than normal, we're going to see those yield numbers increase relative to those early season estimates in August. And that brings us to the left-hand side. This is the actual accumulation of growing degree days in the 2025 cropping season. We have the black line would be the accumulation of days on a normal year. The red line is 2025. The banded areas, the shaded areas here are the all-time record high and all-time record low. And then down here, the accumulated departure in the gray area down below that, you can see the departure, the deviation from normal. That as we got just about to the middle of June, it started getting significantly warmer than normal, and that has built throughout the entire summer and now toward the end of the growing season to the degree such that we are seeing the accumulation of growing degree days for the 2025 corn crop at all-time record highs. This is the warmest, this is the fastest we've accumulated growing degree days since this information has been collected. And much of this data set goes back to the late 1800s. So they've got a very long depth and a well of information. And so if I follow Elwyn's logic, that would provide some indication that we're likely to see that yield number come down compared to August. And we already have. They made that step in September. Would they made a step down again in October? And that's what we don't know. And so that's kind of what we're trying to figure out. So the next question is there a correlation then between how warm it was and what that final yield adjustment ultimately turned out to be? And you can kind of estimate it. It's not real exact. There's a lot of noise on this chart, but based on these growing degree day departures, deviations from normal, this data goes back to 1980. And it would indicate that when we have a growing degree day that is warmer than normal, which would be indicated to the right-hand side of the chart, these are growing degree days from 100 to 200 to 300 warmer than normal, it tends to have a negative impact on the yield compared to August. And so it'd be a yield going down, temperatures going up. Yields going up when the temperature goes down, when it's cooler than normal. Based on that rough model, that would suggest that the final corn yield in 2025 is going to be 5 bushels below what the August estimate indicated. So if we plug in that number, in August, USDA was expecting a yield of 188.8. Actually, the model spit out a negative 5.6 yield reduction based on those accumulation of growing degree days. That would put us at a 25 average yield of 183.2 bushels per acre. Again, that's just kind of a rough estimate based on those kind of relationships over time. Still a record yield, but it would indicate the impact, particularly of those warmer temperatures here at the end of the growing season. Now, lots of other stuff is going on, obviously, just drought conditions in and of themselves, disease pressure, as we just mentioned, positive or negative. So those kind of things will play into the equation. So what might we adjust that WASDE table, since we didn't get it in October, based on kind of what we know now, based on what the temperatures were doing. And then we also had the grain stocks report that came out at the end of September, and it had a little bit of a surprise too. So let's plug in some of those numbers into the WASDE table and see where that leaves us. I've got the 2024 supply and demand estimates, September 2025, 26 that we had. That's the last official WASDE from USDA. The new information, I'm going to plug in the yield of this new balance sheet, and I'm going to use that 183.2. That then would lower our production number from 16.8 billion bushel crop to a 16.5 billion bushel crop, still a record crop. 183 is still a record yield. A relatively significant change compared to that September number. The grain stocks report indicated 200 million bushels of corn in the bin carrying over for this new year that we didn't know we had. So that was a relative bearish surprise to the market when that came out at the end of September to show that larger carryover number. So if you plug in a larger beginning stocks number, but you lower the production number, total supply is down about 100 million bushels, but one kind of offsets the other. I did not change the use estimates. Don't think we have enough information at this point to substantially justify making a major change in those, other than are we maintaining that export pace to get near that 3 billion bushels of exports? That's an outstanding number, very highest on record, strong export presence for corn in the global marketplace for U.S. corn. And so we need to hold that. Is really important to keep this use numbers up and the ending stocks numbers down. Plug all that numbers in. We bring ending stocks down that 100 million bushels. A 48-day carryover goes down to a 45.5. That might offer us a little support on the season average farm price, even here late in the season. 390 was the estimate back in September. Just plugging these numbers into my price model would bump that farm price up about 20 cents. I've got it up to 408. And these numbers would generate an expected average futures price in October of $4.11 a bushel. I looked this morning and the futures are trading at about 412. But it seems to me that the market is kind of trading these kinds of numbers. We don't have verification of them yet. We don't know that yield number. We don't know USDA's official beginning stock number or what that production number is going to be. But based on kind of what we've maybe been able to determine from some of these other sources, kind of gives us maybe an indication of kind of what the market is thinking. And of course, the verification of that as we get these reports open back up will be very, very important for future market direction. And this chart just demonstrates the importance of that days of use on hand at the end of the marketing year relative to the season average farm price over here on the y-axis. And I've got those, again, those conditions tightening up just a little bit from a 45, a 48-day carryover and a $3.90 price to about a 45-day carryover and a $4.10 price. So nudging us back to a little higher prices, a little more bullish market outlook, which could be very, very important late season to give us a little momentum perhaps to wrap up the harvest season for the 25 crop and put us in a better position as these prices might reflect a more bullish or more positive upward trend for that 2026 corn market and those marketing opportunities early in the season. What's going on globally? Again, we don't have our crop condition reports. We don't have USDA's production numbers from around the world. But there are some resources that maybe just kind of give us a glimpse of what's going on. This is an organization called GeoGlam. They have a monthly crop monitor, and it is cropping conditions in season around the world in the major growing areas. In your condition ratings over here on the left, if it's blue and green, it's good. If it's yellow, it's of some concern. It means that orangish kind of color, that would be a poor rating. And you can see just a glance across that map, there's a lot of green and blue on there. There's some really good growing conditions for wheat, for corn, for soybeans, for rice, all around the world. The areas where you'd start to see some concern, well, let me start over here with in the Western Hemisphere. Most of the, of course, the Corn Belt is really good, and even beyond the more minor growing areas of corn in this country, very, very positive. South America looks good as they're planting their crops for 2026, and they're harvesting wheat in Argentina. Now let's move across, Europe and Asia. Most of Europe is good until you get into southeastern Europe. Then we've got some dry conditions that are going to impact their corn crop there and could likely impact wheat planting this fall. Drought and war conditions continue in Ukraine, particularly in those wheat growing areas over here in the Donbass region, southern Russia, the northern Caucasus. It's dry. That some kind of under even some poor conditions in small areas of that southern Russia. When you get over here to northern Kazakhstan and Siberia, actually it's too wet. They're trying to harvest their spring wheat crop, and they're having some difficulty getting the crop out of the field. Most of India, China, their major growing areas here in the east, very good shape. And if you look in Australia, of course, things look good as well. As has been mentioned, however, we are in La Nina conditions currently, and those are expected to persist at least through February. This would be the probabilities of La Nina conditions, which is the highest probability through December, January, and the end of February. The Climate Prediction Center would estimate a 50% of La Nina and a 40% chance of a neutral condition. Starts to shift then a little bit as we get into March. And perhaps these La Nina conditions fade by April and into May in the growing season. What does that mean for global production? That's kind of a messy kind of map. Again, if it's brown, it's bad. If it's that bluish greenish color, it's good. To wetter than normal and drier, warmer and drier than normal. But think of the time frame. Let's kind of focus on that time between October and February. Well, in the southern aspects of the United States, the southern plains in particular, that puts us in a dry condition for much of this winter, which also coincides with drier conditions as you get down into Argentina. Not so much, it kind of creeps into southern Brazil, but primarily a little further south as you get into South America. Actually, these conditions will make it wetter than normal across the northern areas of Brazil. And again, they're planting their spring crops right now. As we then move over into parts of Europe, really doesn't touch the major wheat producing areas as you're looking into from southern Europe, Ukraine, southern Russia. but there does tend to be a drier influence if this does hold on a little later on. Where we're likely to see some drier influence, look over here in China. That weather pattern can result in drier than normal conditions from November to January. That would be right at the heart of this current La Nina pattern, and that would encompass much of the major growing areas in eastern China, which would be primarily their wheat crop, if we're looking at in-season impacts, and then of course the wetter conditions you'd see in much of Southeast Asia and across Australia. Which in La Nina is much more favorable crop prediction. So maybe a little indication of if there's some weather hazards on the horizon driven by a weather event like the La Nina that we're likely to be in for the next several months, that might have some impact on production expectations coming out of these major crop producing areas around the world. The current or the last, the last estimate for the corn crop around the world was over a 50 billion bushel crop. Just a significant step higher, record crop in the U.S., record foreign production. Again, just a really favorable scenario for a big crop on the horizon. And the price pattern of the December corn futures contract, kind of following along seasonal patterns generally. The red dotted line was what you'd normally expect that futures market to do, is to increase from January to about mid to late June, fall off with the season low in late September, early October, and then get that little post-harvest rally and maybe a little upward price momentum going into the end of the year. Are we going to see that this time? To give a better picture of that, what I'm going to do is I'm going to shift that price over about a month and see how those line up on the seasonal pattern. You can kind of see some relationship there. Let me shift that thing over. Look at that. It's falling, even though we kind of maybe didn't high at the right time. We've kind of bottomed that thing out, and the bounce we've had coming out of that kind of the harvest low, which in this case came in August, not September. We're kind of following along what the market would suggest seasonally, and I think there's a point to be made from this chart. What do we trade when we don't have fundamentals? Well, many traders will turn to technical analysis. And one aspect of technical analysis is our seasonal patterns. Is that corn market, based on its seasonal tendency, is that a buying opportunity or selling opportunity? Then, of course, you'd have other tools, stochastics, and relative strength indices, and moving average, convergence, divergence, all these tools that traders would use in the absence of fundamental information. But we're at a point in the season which I think is critical if we're going to establish a pattern, perhaps to move these prices, give us a little better price moving into late fall and early winter, and set us up more favorably for 2026 or not. And I think we're at that critical juncture. And I certainly think if we had fundamental information verifying kind of that yield number would be important for us. And we'll see how that plays out. So again, I think we're still looking at a world of high cost, tight margins. That balance sheet is tight globally. And so I think the markets, wheat, corn, are very susceptible or vulnerable to a major production change in any key growing area. And so if the La Nina brings us that, or some other event, I think we could certainly see some significant volatility returning into these markets, even in this world of trade uncertainty and some of the disruptions of our normal trading relationships. And I'm going to close with this. We do have our Master Marketer Marketing Plan programs right around the corner. We're going to be meeting at the Wharton Civic Center next week, October 22nd and the 23rd. These are 2-day marketing plan sessions. We're going to cover many of the risk management tools that we always talk about at Master Marketer, but particularly in light of changes this summer in the One Big Beautiful Bill that was passed with the farm support, tax implications, finance arrangements, working with your lender in this new environment. How do we craft a safety net, given kind of what the world looks like right now? Again, we'll be in Wharton next week. We'll be down in Weslaco. That'll be on November the 12th through the 13th. Registration is open, and we'd be glad to answer any questions, provide information as people have questions. So with that, thank you much. Again, always appreciate being on the program. And Bobby, I'm going to pass it back over to you.
Well, thank you, Dr. Welch. Like I say, it's always amazing to kind of see how all these pieces start falling into place to get us where we're at. So again, very pertinent information, and we appreciate you being on with us this morning. So now we got up Miss Angie Martin with the Texas Corn Producers Board. She's industry and affairs director, and we're glad that she's on with us this morning. She always brings us some good information as well. So, Angie, I'm going to turn it over to you.
Well, good morning, and thank you for having me, Bobby.
Uh,
I don't know if I can live up to Mark Welch's intro a while ago. I appreciate Mark, and Mark always has great information. And as far as insights, we have a lot of corn, and of course, y'all are through and done, put combines up, but we're still harvesting up here in the Panhandle. Uh, Part of the Panhandle's wrapped up, but the North Plains is still growing strong. So we've got a lot of corn. Um, we've got some storage problems. We had a good wheat crop. Then we've had that is still sitting in bins. So we've got sorghum that's out on the ground, and we've got corn that they're trying to figure out where they're going to put it all. So I think our yields across the state have been very have varied. I know in the Gulf Coast region, some of the early corn wasn't as good. The later corn was better as far as yield, but we just have a lot of corn. And, that old basic economics, supply and demand. We have a lot of supply and we don't have a lot of demand right now. So it's really it's very concerning. We have a lot of things happening that outside pressures on that. We've got some trade tariffs. We've got some trade partners that have always been good partners. As I mean, for the most part, down in your area, a lot of your corn goes to Mexico. Now, because of USMCA, that was our NAFTA 2.0, if you want to call it that, those products have no tariffs on them because they are protected through USMCA. The bad thing is USMCA is up for review and revision, and there's always opportunities there, but we really need to keep USMCA, especially for our South Texas growers. The Mexico market is just very, very important. So we are already starting to work legislators on that and remind them of the importance of our trade with Mexico. Shifting a little bit to more of the policy things that have been going on, you had the ECAP, which was the economics assistance that came out in June. You should have received it was paid at an 85% pay rate. You should have received the other 14% before the government shutdown happened. They got that out the door, I think, on the 29th and finished, I think some of them finished hitting on the 30th of September. So that particular program should have been paid out. You also had some opportunities on the SDRP. That was the Supplemental Disaster Program. And that was, hurricane, wind, drought, heat, all those things that were a factor in that. I will make comment, it was drought and heat. In the past, that's been some problems on getting your payment because of how your certification was on your failure versus how your crop insurance adjuster described it. So it is both of those. A lot of those had been paid. We were getting ready for what they call stage 2 of that to deal with some of the ones that weren't automatic in the stage 1. That was hopefully going to roll out the 1st of October. When the government shutdown happened, that all went on hold. So that is on hold until the government opens again. And then that should return to being calculated and paid out. Of course, ARC PLC payments, that's another thing that's been on hold due to the government shutdown. If you think I know the answer to the government shutdown, I hate to disappoint you. I don't. I'm not sure who does. There is a lot of back and forth and a lot of finger pointing. And I am very hopeful that some of our statesmen will step up and we'll get this resolved so our USDA agency can get back to work, which includes our county offices, our FSA, NRCS, which are very important to our growers. So I hope that we are going to return to that. Hopefully they'll get something worked out. This is a time that I think it's very important that you're a part of an association so you can stay up to date on what's happening and what you need to be doing. Our website's texascorn.org. You can join our association there. You don't have to grow corn to be a member. I would encourage you to be a member so you can stay in touch. There there's a lot of things that have happened this year as far as policies that affect you directly. And one example of that, as Mark Welch was talking about for master marketers, was the Big Beautiful Bill. There were a lot of good things in that. A lot of our priorities were handled through appropriations in that bill. But there are still a few things left. That's why you've seen some discussion about G.T. Thompson, the chairman of the House Ag Committee, wanting to finish up the skinny bill. There's a few programs that were not covered under appropriations that need to be cleaned up. The overall act needs to be reauthorized, and hopefully we can get the government back open and we can get that taken care of by the end of the year. I encourage you to look at what was in the Big Beautiful Bill. There were a lot of things in there that are helpful for our growers, including some tax stuff. And like I said, I encourage you to be a part of an association, especially ours, and to go to listen to what Mark has to say about that. The other thing I would say is it's both a policy issue as well as a production issue. As on the New World screwworm, we have talked with Texas cattle feeders as they have worked very hard to work on that. One of our biggest customer in Texas as far as corn is our livestock industry. So it's really put a limit on our cattle in our feed yards because of the border being closed and because of the screwworm, which we do not want. And we have been in contact with them on how can we help. Is there anything we can do to help? Because we know that's important. And we see a lot of discussions about input cost. We have been talking about that for a long time. We've been very concerned about the continued increase in fertilizer prices, concerns about consolidation of companies that you have to use for your farming operation. So we have been watching that and talking about that and bringing that to people's attention. And it seems like some of the rest have jumped on that now. And so I think that there is a lot of discussion happening at a high level about, this is a very big concern, not only on the price, but the availability. And some of that gets caught up in some of the trade issues as well. So those are some things that we are continuing to work on and watch, because we know bottom line is important. And it's terrible that we've had all this corn and we have nowhere to go with it. We've got good crops and no price. And it's we understand that, and we are working diligently to try to do all we can to rectify that situation. Um, on our checkoff side, which is our Texas Corn Producers Board, um, a lot of our research that we are able to do from reinvestment of your checkoff dollars, of course, has been on aflatoxin. This past year, we had some projects on the leafhopper that y'all dealt with, and a couple of the other production issues that have through disease and um, uh, different things that have affected the crop. So the RFPs for our research committee just went out last week. And if ever there is a research project that you think needs to be brought to our research committee's attention, I hope that you will talk to one of our directors in your area. That would be Colin Chopless, Charles Ring, Ben Gwynn, Jim Shigerick, and let them know, or you can always contact me or our office, because it's important that we're taking care of what is actually happening out on the farm. So I just encourage you to let us know that. And I'll finish up with just saying, I know there's a lot of stuff happening, and not all of it's positive. There's a lot of negative out there, but I encourage you to, um, you know, farmers are resilient, and I'm a farmer's daughter. There's always next year, and we're going to get through this. And I encourage you to keep your head up and let us know if you have particular issues that we can help with. Another thing that we've worked on is a new tool in the crop insurance toolbox that'll be coming out. It's called CLIP. It's a crop and livestock income protection. It's under the revenue programs. And so those are some things that we're trying to figure out all that we can do to help you make the most of your bottom line and keep it in the black and not the red. And we're here to serve you. So if there's things that we can do to help, I encourage you to call our office, call our contact information is on our website, and let us know. Bobby also has our contact. We're happy to talk and to do whatever we can. So I appreciate being a part of the program today. And Bobby, if you have a question or if there's something I missed, let me know. But again, our website's texascorn.org, and there's a lot of information on there, and I think that would be helpful for you as well.
Uh, Wonderful information, Angie. We appreciate it. I know a lot of us see kind of different things that y'all are involved in, and we appreciate all that y'all are doing to further corn production and agriculture as well. So again, thank you for being on with us this morning. It's just like I said, always amazing how much good information comes out of this little hour of get together with some very capable economists and boards that we get to work with. And again, we're thankful for the Texas Corn Producers Board, the Texas Sorghum Producers Board, and the Cotton Board, who constantly are involved in our effort, and we're greatly appreciative of that. Kara, you got anything you want to add?
Bobby, I think it's only fair that we give you a shout out and thank you again for your leadership and all you've done to make sure these continue to happen. I know you've carried the weight of this program for the bulk of the 2024-2025 planning year, and it looks to start the same way for 2025-2026. We appreciate all the folks that you've reached out to coordinate getting them on the meetings in the morning. Because again, it may be a handful of us that join early in the morning, but from what I gather, it looks like quite a few folks have found this resource and refer back to it after we get it posted and share it with the public.
Sure. And any of y'all want to move the video out to your people, it's all appreciated. So if we have no other comments from any of our economists on board, we'll say this one's done for this month.
Thank
Thank
y'all.
you.
Good to be with you.
See you
Yes,
later.
again, thank y'all for being on.
Thanks.
Have a good one.